interpret within a short span of time. So we are trying to do our best, and also given the time lag and the distances, etc. So please bear with me. If you have some questions, I may not have been able to apply my mind to them earlier. We will do our best. I'm going to share a screen here right now. Are you able to see the screen?
Yes, sir, we are able to see it. Yes.
So we talk about the state of the economy. Although this presentation deals with the fiscal third quarter numbers, we do have some information to tell you. First of all, the fiscal third quarter numbers were very strong, attaining a growth rate of 8.4% year on year. And the full year growth numbers as a result are up to 7.6% instead of 7.3%, which we had earlier. Of course, there is a slight downward revision to the previous year's number from 7.3 to just about 7%. And therefore, I think naturally you do have from 7.2 to 7, and therefore you have a slight advantage of the base effect that is coming in there as well. And if I look at the next slide, the agriculture sector in FY24, as you might have seen from the data for the first 9 months, obviously has been somewhat lackluster because we had an erratic monsoon. Kharif harvest is on the lower side. But the good news is that the Rabi sowing has been quite good compared to last year. It's flat. And the predictions of withdrawal of El Nino also make the case for a normal monsoon in the next calendar year, as well as good harvest both for Kharif and Rabi crop next year. So in that sense, agricultural sector value added should rebound in FY25, and that would naturally boost rural incomes as well. Private consumption share of GDP has come down, which is understandable after the big jump in the previous financial year. And also other sectors of the economy are now picking up, for example, the gross fixed capital formation. So the slight reduction from 58% to 55% plus of GDP for private final consumption expenditure is not a sign of distress or slowdown, but is also a reflection of the demand growth in the economy being more evenly distributed than before. So I have already spoken to you about the 8.4% projection for the estimate for the fiscal third quarter. So I will move on from this slide to the next slide. What you see here is, of course, India's GDP growth numbers continue to outstrip the growth rates that we are seeing in several other economies around the world. And we have talked about it many a time in the past. I'll repeat it. Those who are not speaking, could you please mute your lines? Those who are not speaking, please mute your lines.
Somebody's TV switched on.
If somebody has a TV on, they can choose whether to watch the TV or listen to the press conference. Could you please mute those volume indicators, please? Thank you. India continues to be an outlier, and we have mentioned the reasons for it in the past. It is because of the ability to withdraw the COVID stimulus, and also by keeping therefore creating fiscal space, and also making sure, I think the external noise is still coming, please. Can you please mute those lines?
Please, whoever has got their TV switched on, please switch off your TVs while the briefing is on. Any other device which is on and whose volume is on, please switch it off.
So the reason for India's performance continuing to do better is because of the COVID management, as well as the emphasis on capital investment, which has now begun to crowd in private sector as well. Uh, Industrial sector growth, as I mentioned earlier, has picked up quite well. You can see it in the gross value added sectoral growth breakdown as well. Mining, manufacturing, construction sectors. Could you please mute your lines? There is a lot of ambient noise. Can you please help by muting your lines?
This is Aaj Tak and BTTV. Please mute your mics. Aaj Tak and BTTV.
Mining, manufacturing, and thank you. Mining, manufacturing, and construction sectors gross value added. You can see that both in nominal terms and in real terms have done quite well. Of course, if you look at the growth rate in the first 9 months of GVA in these sectors, real growth is higher than nominal growth because they are usually deflated by the wholesale price index, which has been negative this year in terms of the year-on-year change for the FY24, and that is the reason why the real growth rates are higher than nominal growth rates. That said, even the nominal growth rates show a good recovery in these sectors. Hello, can you please help me by muting your lines? Hello. So industrial growth rate has now picked up. That's why I said there is a better balance of growth, and I already walked you through the reasons why agricultural sector's gross value addition is lackluster, but I expect a recovery next year. And the economy macro vulnerability index, which you have prepared, and the details are given below. The macro vulnerability index is actually trending down, which is as it should be when the macro vulnerability index goes down. It did pick up in the years leading up to the pandemic, and now it is on its way down, which is a good sign that the overall macro economy is displaying stability, because it is calculated by a simple combination of fiscal deficit, current account deficit, and retail inflation. This is also shown in the macro uncertainty index for the Indian economy. And if I look at the agricultural sector performance, we have talked about it earlier already, so I'm not going to go into the details. I've given you my explanations for the tepid performance this year and the reasons for the recovery next year. In terms of industrial growth, as one would expect, as the private sector investment begins to rise, and as the rising incomes and consumption recovery in general spilling over from last year to this year is also now crowding in production. We can see that in the continued ebullience in the purchasing managers index, IIP growth rates, and increase in cement production and steel consumption, and also in the steady pickup in the railway freight traffic growth as well. In terms of the services sector, although once again the hospitality sectors show a slightly lower growth in the current financial year's 9 months compared to the previous year, we must remember that it is coming off a very strong recovery in FY22 and FY23. It is more a sign of stabilization rather than any underlying weakness at the moment. Purchasing managers index in the services sector is doing even better than the manufacturing sector. Digital transaction volumes and foreign tourist arrivals are now appreciably above the pre-pandemic average. And in terms of the revenue per available room is rising, and the overall daily rate is also picking up, so indicating good business and leisure travel in the country. Urban demand conditions, whether you look at passenger vehicle sales or domestic air passenger traffic, overall consumer confidence, and as I mentioned earlier, construction sector recovery is also evident in the housing sales. Now, there is always a question mark in people's minds, notwithstanding evidence. People tend to go by their perception, but the rural demand, as you can see on the top left, volume growth in rural fast-moving consumer goods has been rising for 4 consecutive quarters starting from Q4 of the last financial year. And both 2 and 3-wheeler sales are on a rising trajectory. Increase in tractor sales we have seen in January over December, and in general in the current financial year we are seeing tractor sales doing quite well. But as I mentioned earlier, with the anticipated better value addition in the farm sector next financial year, rural demand growth and rural income growth will be even better and more evident in FY25. And then if you look at the household monthly personal consumption expenditure, we can see here compared to the 10 years ago when we had the household consumption expenditure survey, we can see the big recovery in the overall consumption spending in rural India and urban India. And many news reports have shown how the share of food expenditure has come down in both rural and urban India, giving them more space for discretionary expenditure, and how much of the expenditure growth has happened in the lower fractiles rather than in the higher fractiles. So in general, the story is one of rising purchasing power and reduction in the poverty headcount ratio, as well as a better distribution of consuming power in the hands of the population, more so in rural India than in urban India. Now, moving on to the inflation data, food inflation has been volatile, but we must remember food as a share of expenditure is coming down, and the bottom income segments of the population are shielded by the food price inflation by the government's Pradhan Mantri Garib Kalyan Anna Yojana program, which is now extended for 5 more years. So in some sense, the food inflation as measured by the data is not exactly the food inflation that the actual consumer faces, because many of them do get at least certain quantities of food items for free. So in that sense, the food inflation does overstate the impact on the consumer wallet. Stable food prices assisting in lower inflation. WPI inflation has entered positive territory now. That is why you are seeing it in the recovery in nominal GDP growth numbers now at 9.1%. Inflation expectations remain stable to slightly lower. In fact, the current perception is quite low, and the 1 year ahead perception has remained slightly lower but stable. Global demand has been a challenge given uncertain global growth. Many regions of the world, Europe and East Asia, are showing moderate growth, and therefore overall export growth performance has been middling at best. But nonetheless, due to the decline in prices of manufactured imports and also decline in services imports, the overall service sector surplus is quite good, and the overall trade balance, the deficit, is shrinking. So the external sector is showing no signs of vulnerability despite the poor performance of exports in general because of global demand conditions. We must also note that, however, remittances by Indians went to achieve a record in 2023 and will do so, expected to do so again in calendar year 2024. I just spoke to you about the external sector being stable. Current account deficit is heading towards just 1% of GDP. And the forex reserves now cover about 11 months of imports, and FPI flows are at $33 billion. We should also note that the gross FDI inflows into India are doing quite well compared to the last financial year in the first 10 months of the current financial year. The net FDI flows, after we take into account repatriation, is lower. But then repatriation arises on account of investments made at any time in the past. They do not reflect the current sentiment. And sometimes repatriation also happens when the investment has been extremely profitable, and as the underlying investment goes public, that investment is picked up by portfolio investors. So in that sense, focusing on gross FDI to gauge foreign investor interest in India is more appropriate, because repatriation doesn't pertain only to the current financial year, but it could be arising on account of investments made at any time in the past. Government's commitment towards fiscal management is evident in the fiscal deficit as a percentage of RE in the first 10 months of the year, and also in the tax collections, as well as in the continued steady increase in the average monthly GST collections as well. If you look at the quality of expenditure, year-on-year growth in capex in the first 10 months compared to year-on-year growth in revenue expenditure, and the overall decline in revenue to capital outlay ratio by more than half, 7.5 to 3.7 times the ratio, shows continued emphasis on capex and continued monitoring of the quality of fiscal expenditure on an ongoing basis. Private sector investment activity is evident in micro data as well as in aggregate data. Import of capital goods, increased production of infrastructure and capital goods, and expansion in the capacity utilization in the manufacturing sector. And more importantly,